Guys, I will be discussing a few more things which are related to the syllabus of P6 and it's basically relevant to the topic of VAT. The topic is about land and building. Now, if we consider land and building, then the supply of land and building could be considered as like one of the three types of supplies. Either it's a zero rated supply, or it should be taken as a standard rated supply, or else the supply of land and building is like going to be taken as an exempt business. So if a building is like going to be sold or like is given for lease of more than 21 years, then the sale of such land and building will be considered as a zero rated supply. As far as the sale of residential building or any building which is being used by a charitable organization will also be considered as zero rated supply for VAT purposes. If any commercial building is like going to be sold, that is, if it is like going to get sold within 3 years of the initial completion of like construction, then such types of land and buildings are to be taken as standard rated supply. That means whenever such buildings are going to be sold or such kinds of lands are going to be sold, then standard rate of 20% will be applied over the selling price of either land or building. So is the case with commercial building, as in if a land and building is like being used either for residential purposes or commercial purposes, they'll also be taken as a standard rated supply after 3 years if option to tax is like going to be taken up. As far as the rest of the land and buildings are concerned, they are like totally exempt for VAT purposes. As in, if it is like going to be leased for up to 21 years, if residential charitable, if it is like residential or charitable building, or any commercial building after 3 years if no option for tax has been applied. So we can say that if a commercial building is sold not in the initial 3 years of their construction, rather after 3 years, then it might be like considered as an exempt transfer, or it might be taken as a standard rated supply. It all depends that whether the option to tax has been taken up or if the option to tax has not been taken up. Now once again, as we have seen that if the commercial building would have been sold in the initial 3 years of their completion of construction, then the supply would be treated as a standard rated supply. But if it is like going to be sold after 3 years of their construction, then the taxpayer has actually two options, whether opt to tax or not opting to tax. That means to consider that supply as an exempt one. So what happens if option to tax is like going to be taken up? If the person is like either going to sell the building or basically is going to give the building on lease after 3 years, and he's like going to take an option to tax, then a few conditions are supposed to be met. The election for opting to tax should be filed within 30 days of signing the contract. This contract can be revoked within initial 6 months of signing the contract. Otherwise, it will be revocable after the 20 years of signing the contract. Election couldn't be made for a specific part of the building, though the election for each and every building has to be made separately. Now, what happens if option to tax has been taken up? Whenever the land or the building is like sold, it will be treated as a taxable supply, and on the selling price of the land and building, standard rate of 20% will be applied. If such building is like going to be rented, then whatsoever the rent is like going to be received whatsoever the rental figure from the building is like going to be received, that is also going to be considered for VAT purposes, and on the rental figure, 20% VAT rate will have to be applied. So as the option to tax has been taken up and the supply has become a taxable one, so landlord would then get a chance to recover any input tax that has been paid on purchase and the running cost related to that building. So that simply means whatsoever the cost we have incurred over the building, either to purchase it or any revenue expense related to that particular building for which option to tax has been taken up, its total input VAT is recoverable. But whenever such buildings are going to be eventually sold, then the new owner once again will be able to have this option that whether he would like to take an option of not opting to tax or he would like to opt for the tax. Here's another topic which is called partially exempt businesses. So we can see that all the businesses which are involved in like selling both types of supplies as in the taxable and the exempt one, then whatsoever the input part is like recoverable to taxable in making like taxable supplies, that is for sure recoverable. And we all can say that whatsoever the VAT is like relevant to the making of like exempt supply is like not recoverable. But then the confusion arises that what is like going to be done with the overheads, as in overheads which are going to be shared by both type of supplies as in the taxable and the exempt one. Then how is it like going to be determined that whether that how much part of the VAT is like going to be recoverable and how much VAT is like not going to be recoverable. So once again, I'm going to start with this thing that all those businesses which are engaged in like making both types of supply, the taxable one and the exempt one, all input VAT is not recoverable because some of the input VAT is like relevant to the making of exempt supply. So we can say that once again that whatsoever input VAT is like directly relevant to taxable supplies, that means whatsoever VAT we have paid on the purchases or the expenses related to the making of taxable supplies, that is of course fully recoverable. Whatsoever input VAT is like directly relevant to the making of exempt supply is of course not recoverable. But wherever input VAT is like indirectly attributable, that means if it's relevant to overheads, then it is like partially recoverable because some of the VAT is like relevant to the making of exempt supplies, which is like obviously not recoverable, but some of the overheads must have been incurred for the sake of making taxable supplies, and hence whatsoever VAT we have paid on it, that is surely recoverable. Now the proportion of the recoverable figure of VAT could be determined with the help of this table, as in we need to see what the total figure of sale has been made, and we need to take a percentage of taxable sales in relation to it. Whatsoever the percentage is like going to rise, that means this much VAT is like going to be recoverable over such situations where VAT cannot be directly attributable. Here comes a table in front of you. That is, whenever a business is like involved in making both types of supplies, we need to see that whenever we are going to make either standard rated supply or the zero rated supply, because they both are relevant to the taxable category, then whatsoever VAT we have paid, that is claimable or recoverable. Whatsoever VAT is like relevant to the making of exempt supplies, of course that particular VAT is not claimable, non-recoverable. But when it comes to overheads, then we'll be applying this percentage to see that how much VAT is like recoverable and how much is like non-recoverable. Now, as we can say that this is the figure of VAT which is non-recoverable, not recoverable, we still have this option to recover this VAT if this de minimis limit, you can say if this test is like going to be applied. So once again, this non-recoverable portion of input VAT could become claimable or recoverable if following conditions, if all of the conditions are going to be satisfied, as in whatsoever exempt sales are made that is either equal to or less than 50% of the total sales. This is actually what the supply is, that means the sales figure. If the exempt sales figure is either equal to or lesser than the 50% of the total sales figure made by the business, then we can see that if the rest of the conditions are going to be satisfied, then this non-claimable VAT would also become claimable. Another condition is that if one of the three tests is if one of the three tests is going to be satisfied, then non-claimable portion would definitely become claimable. That the total input VAT is either equal to or less than 625 on average for a monthly basis. So once again, let me show this. So see, this is the total claimable figure of VAT, which is like the total of claimable and non-claimable. This is the total figure of input VAT. If this figure, when we take the average of this figure on a monthly basis, then if the average is either equal to or less than 625 for a month, then the whole non-claimable VAT will become claimable. Or you can also say this, that if total of the input VAT, once again total input VAT as in both claimable and non-claimable, minus input VAT that is directly relevant to the taxable supplies, is once again either equal to or less than 625 pounds for a month on average basis, then we can also claim the non-claimable portion of VAT. Once again, whatsoever the total VAT figure is, if we deduct the VAT which is directly related to the making of, which is directly relevant in making the taxable supplies, whatsoever the figure is left, we take the average of this figure. If the average is either equal to or less than 625 for a month, then the non-claimable portion for the VAT will also become claimable. If the total non-claimable input VAT is either equal to or less than 625 pounds per month on average basis, then we can say it's such a niggling figure, it's a negligible figure, which is why whatsoever the non-claimable portion of VAT has been paid, that is surely recoverable. You can see once again that if this portion, non-claimable, which is related to the unattributable figure of sales and the attributable figure of exempt sales, whatsoever the non-claimable portion of VAT is, we need to take the average of this figure. If the average of this figure is either equal to or less than 625 pounds a month, then the whole non-claimable portion of VAT will become claimable. Now there is another topic which is called capital goods scheme. This is once again the topic which is relevant to all those businesses which are involved in making exempt as well as taxable supplies. So whenever such businesses are going to incur money over the purchase of land, building or computer and the computer equipments, then once again some part of the land, building and computer would be involved in making taxable supplies, and some part of these assets must be involved in making exempt supplies. Initially, we are basically able to recover the VAT over the initial use of this asset, but then of course as the utilization of such things keep on changing in the next years, then adjustment has to be applied. The adjustment has to be applied for 10 years in case of land and building, where the value of the land and building is either £250,000 or more, and the adjustment period for computer and its related equipment is of 5 years, provided the computer and computer equipment will be costing either £50,000 or above. So, for instance, I can say that I have purchased a computer for I have purchased a land for £3 lakh, and it is the business is 70% involved in making taxable supplies and 30% involved in making exempt supplies. Initially, on the purchase of this land, whatsoever the VAT I have purchased over the purchase price of this figure, only the 70% of the VAT is recoverable, because 70% of the building was involved in making taxable supplies while 30% was involved in making exempt supplies. So I would be able to recover 70% of the VAT that has been charged over the purchase of land and building. But of course, there can be a chance that in the next year, my business would start making 60% of the taxable supplies and 40% of the exempt supplies. In the next year, there can be a chance that 95% of the business will get involved in making taxable supplies, while only 5% of the business will be involved in making exempt supplies. So as the utilization of land, building or computer equipment might get changed in the subsequent years, so adjustment for any overpaid or underpaid tax has to be made. This is the formula which is going to be used for making an adjustment. That is, whatsoever the total input VAT is, the percentage that we had already claimed in the year 1 minus whatsoever the percentage of taxable supplies in the current year, and that has to be divided over 10. It is going to be divided over 10 because it's related to land and building, but the formula will get changed to 1 by 5 if it's related to computer and computer equipments. So how does this whole thing work? That whenever we are going to make a purchase, then the input VAT is recoverable. The recoverable figure of input VAT is going to be derived by the following thing: that whatsoever the cost of asset is and the VAT figure related to it, which is obviously the 20%, we need to see that initially how much percentage of the building is being involved in making taxable supplies. Whatsoever the percentage of use is, that is initially recoverable on the purchase of asset. But in the next relevant years, the recovery of the input VAT is going to be judged again. We need to see that whatever had been the total value of VAT, and then what was the percentage of use, taxable use in the year 1 minus whatever the percentage of use in the current year. Whatever the difference is, that has to be divided over 10. Either this figure is payable to government or it is going to be recoverable from government. Eventually, when the asset is sold, when land and building is going to get sold, we can see that more than 3 years after the completion of the building must have gone. Then at the point of disposal, 2 things might happen: whether we are going to opt to tax or we would not opt into tax. If option to taxes are going to be taken up, then input VAT recoverable or payable is going to be determined with the help of this formula. That as now the 100% of the building is going to be taken as taxable supply minus whatsoever the percentage of taxable use in the year 1 into number of years that have been left divided over 10. But if no option to tax has been taken up, then whatsoever VAT we had already claimed, that is going to be payable. That means that at the point of disposal, this is going to be taken as an exempt supply. So minus whatsoever the taxable use in the initial year into number of years divided over 10. This is how we come to know that how much VAT is still payable or recoverable to and from the bank. I'm going to put an example in front of you. For instance, there is a company that is going to buy a new building for 5,52,50,000 pounds. So there is a company who has purchased a new building costing 5,250,000. Initially, 40% of the building was involved in making taxable supplies, and of course the remaining 60% of the building is going to be used for making exempt supplies. But after 8 years, let's suppose 50% of the building would then get involved in making taxable supplies, while the rest of the building would start getting used for making exempt supplies. So what is going to happen initially is that The purchase price is 5250,000. We can say it's a gross figure. That means inclusive VAT figure. So into 20 over 120. This is how we'll come to know how much VAT is relating to the purchase price of the good. And as 40% of the building was involved in making taxable supplies. So we need to see that how much VAT is related to this building, which is initially recoverable. The figure is 3,50,000. So we had been able to recover 3,50,000 pounds. For the first 8 years, no adjustment is required. And that is because for the first 8 years, there has been observed no change in the pattern of using the building for making taxable and exempt supplies. But after 8 years, the taxable usage of the building is going to be changed. It's going to be increased from 40% to 50%. That means for the next 2 years, that means for the 9th year and the 10th year, for the next 2 years, 10% of the VAT is more recoverable. Now, how this is going to be done? As we can see that the VAT related to the overall purchase price of the land was 8,75,000 pounds. This was the total VAT, out of which initially we had recovered 3,50,000. We need to see what the total figure of VAT is. This is 875,000. Into percentage we had claimed initially, that was 40%. Minus what is going to be the percentage now, or we can also shift the figures as in by saying that what is the percentage we are going to use the building currently, or what we had claimed earlier, and this is to be divided over 10 because the adjustment period has to be spread over 10 years. So 8,75,000 divided by 10 to 0.1, that means 8,750 is more recoverable, and that is going to be done for the next year as well, because in the next year the percentage is going to be the same as what we are going to observe in the 9th year. So this is how we'll be able to get more recovery of 8,750 in the 9th year and then again in the 10th year. This situation might have been reversed. For instance, if I say that after 8 years, the building would start getting used for 30% of making taxable supplies. So whatsoever the extra 10% we have paid for 9th year and 10th year, we need to pay it back to the government because this would no longer be recoverable.